Welcome to the video. Today we will unpack a common refinancing surprise. Your new refinance loan can be larger than the old loan's payoff, which means you might be paying interest on money you did not need to borrow. We will use a real-style example, payoff of $29,800 versus new loan of $30,634, and show exactly what that difference is, why it happens, and how to get it back. By the end, you will have a step-by-step action plan to prevent paying unnecessary interest. First, let's outline our plan for the session. Here is our roadmap. We start with the big picture of refinancing benefits, then explain why the new loan can exceed your payoff. Next, we present the precise steps to reclaim the surplus. Afterwards, we illustrate the math behind the cost of not recovering it, compare fixed versus variable rates, and map out a practical timeline. Finally, we will check your understanding with a quick quiz. Before we dive in, a brief but important disclaimer. This video is for educational purposes only and does not constitute financial, legal, or tax advice. Terms and processes can vary by lender and servicer. Always verify details with your providers and consider consulting a qualified professional for your specific circumstances. With that said, let's move into the big picture. Refinancing can be a powerful way to reduce interest costs, especially when moving from high rates like 9 to 12% or from volatile variable rates into a stable fixed rate such as 6.6%. However, a frequent and confusing issue occurs when the new refinance loan ends up larger than the old loan's payoff amount. That difference does not automatically disappear. It often becomes an overpayment to the old servicer, and you begin accruing interest on the larger finance sum. Next, let's break down why this happens and where the extra money actually goes. The new lender usually sends the entire approved amount to your old servicer. The old servicer applies it to the payoff-quote, which can include per diem interest up to a specified date. If the funds exceed the exact payoff needed, the extra amount becomes an overpayment. Crucially, overpaid funds do not vanish. They sit as a credit with your original servicer, and you begin accruing interest on the full new refinance balance in the meantime. The old servicer is responsible for refunding the overpayment directly to you, not to the new lender. Next, let's turn to the concrete steps to make sure you recover that money quickly. Follow these steps. First, collect your payoff quote, the new lender's disbursement confirmation, and your account details. Second, call the original loan servicer because they received the excess. Third, ask for the precise overpayment amount and the expected refund timeline, and request the refund via the fastest available method, such as ACH. Fourth, carefully track the payoff quote date and the disbursement date to explain any timing differences. Fifth, once the refund arrives, promptly send it to your new lender as a principal-only payment to reduce the balance and interest charges. Finally, obtain written confirmation that your payment was applied to principal only. Next, let's quantify the cost of not acting quickly. This table uses the example where the old payoff is $29,800 and the new loan disburses $30,634. The difference is $834. At a 6.6% annual rate, the daily interest on $834 is approximately 15 cents. The monthly cost is around $4.59, and over a full year it totals roughly $55. If your refund takes 45 days to arrive, and you only then apply it to the new loan's principal, you will have paid roughly $6.79 in interest on money you never needed to borrow. Now, to make smarter choices going forward, let's compare fixed and variable rates. On the left, a fixed rate around 6.6% offers predictable payments and protection from rate increases, which supports stable budgeting and long-term planning. On the right, variable rates, often 9 to 12% or higher in this context, can lead to payment volatility. They may start lower but can rise with market conditions, increasing risk and making it more difficult to budget. With that context, let's lay out a clear timeline so you know when to follow up and what to document. This timeline shows the key checkpoints. On day 0, you obtain a payoff quote that is valid through a specific date. Within several days, the new lender disburses the full approved amount to the original servicer. Shortly thereafter, the original servicer applies the funds and identifies any overpayment. Within 5 to 15 days, you should contact the original servicer to request a refund and the fastest payout method. Over the next 7 to 30 business days, the refund is issued to you, either by ACH or check. Within 24 hours of receiving the refund, send it to the new lender as a principal-only payment and secure written confirmation. Next, let's capture a quick markdown-based cheat sheet you can screenshot. Use this checklist to organize your process. Track the payoff quote date and expiration, the new lender's disbursement date, the amount disbursed versus the payoff required, the confirmed overpayment amount from the original servicer, the refund method and estimated arrival, and the written confirmation that your payment to the new lender is applied to principal only. The formulas provide quick calculations for per diem interest and the cost of delays. The brief call script helps you ask for the exact details and written confirmation. Now, let's test your understanding with a quick quiz. Question: who is responsible for issuing the refund when an overpayment occurs during refinancing? Options: A, the new lender; B, the original servicer; C, the borrower's bank; D, the credit bureau. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, the original servicer. They receive the overpayment during the payoff process, so they owe the refund to you directly. Now let's try a second question about timing and tracking. Question: what 2 dates should you always track to explain discrepancies and move your refund faster? Options: A, your birthday and the loan origination date; B, payoff quote date and disbursement date; C, tax filing date and due date; D, credit score update date and billing cycle date. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, the payoff quote date and the disbursement date. Tracking these dates explains timing gaps, any per diem interest, and helps you request and receive the refund promptly. Next, let's consolidate the key takeaways. These are the core points. Refinancing can yield real savings, but you must watch for surplus disbursements. Any excess funds create an overpayment, and the original servicer is responsible for refunding it to you. Until you receive and apply the refund to your new loan's principal, you accrue interest on a higher balance. Tracking the payoff quote date and the disbursement date helps reconcile discrepancies. When the refund arrives, send it immediately as a principal-only payment and obtain written confirmations at every step. Now let's wrap up with a quick summary. In summary, moving to a lower fixed rate can be a strong financial decision, but you must monitor for overpayment. When your new loan exceeds the payoff, the difference is not free money. It is an overpayment that the original servicer must refund to you. Request the refund promptly, track every date and amount, and apply the funds as a principal-only payment to your new loan to stop extra interest from accruing. Finally, keep thorough documentation and use concise scripts to accelerate the process. To close, here is a friendly request. Thank you for watching. If this video helped you protect your savings, please like, share, and subscribe. I would also love to hear your refinancing questions or experiences in the comments so we can help more viewers learn from real cases.